Property market warning. This is going to be a two-part video series. In part one, I'm going to give you some of the background data and information on where the property market is right now, where we've come from in over the last 12 months. And in part two, we're going to have a look at where the property market is likely to go. Is it going to boom? Is it going to crash? And I'll give my opinion on where I think that's going and what to do about it. Aussie housing market now tops $8 trillion collectively in value. And I shared in my last video, Australia's economic collapse, that our economic complexity is terrible. Basically, we have two main drivers of economic growth. That is digging stuff out of the ground and shipping it overseas, and our housing market. And what drives the housing market? It's lending growth, credit growth. And you can see just in the last 12 months, since the cerveza sickness, we actually at the beginning of it, we actually had it contract, and you had all sorts of economists, even the banking economists, CBA predicted a 32% fall in housing as a potential worst case, but there was plenty of commentators saying that it was going to fall. In fact, I was in that camp as well. I thought, based on the numbers, everything that we're seeing, that property would fall 20 to 30% over the next 3 years. That was my call. It wasn't 20 to 30% in 1 year, because when you study housing market crashes, they don't fall like that. They don't fall like the share market. I think it's about 5.5 to 6 years is actually the time that a housing market actually falls by. It doesn't fall like other assets. So yeah, but in part two, we'll get to why the housing market, why everyone, including myself, got those predictions wrong. So when we look at the credit growth, look at new loan commitments for housing, you can see a sharp increase in the last little period, the last 12 months or so, and actually investors have now started jumping back into the market as well. So we're seeing investor growth in new lending. When we break it down, what is that owner-occupied purpose being for? You can see that even though we've had home builder, so government grants to build new homes, we did see an increase in that. You can see in the blue. That's since ticked over. So we'll keep an eye on where that goes. But you can see mainly everyone bought existing dwellings. And when we look at the loan commitments on a state-by-state basis, for owner-occupied housing, that is, you can see just about every state went up. However, we're starting to see some of these numbers rolling over, in particular in WA and Queensland, looking interesting. So the new loan commitments for investors, as I said, investors are jumping back into the market on a state-by-state basis. You can see, so we had that in New South Wales in particular, back around 2014, 15, we had macro-prudential rules introduced on investment lending to slow and cool that investment lending. And we had a huge amount of, in particular, overseas investors buying real estate during that period, predominantly going into New South Wales and Victoria somewhat, less of a degree in Queensland. But then when those macro-prudential rules were put in place, it really cooled the investor market, which you can see here. However, that's now jumping back in because investors are sitting back seeing what the property market is doing over the last 12 months and going, hang on, I want a slice of that. So we're seeing investors back in the market. And new loan commitments to owner-occupied first home buyers. So back in 2008, during the GFC, the Prime Minister, Kevin Rudd at the time, doubled the first home buyer grant, and we saw a big spike in the number of first home buyers jumping into the market back then. I know our business was extremely busy during that period. A lot of brokers got out of the industry around that time. I actually was able to accumulate some other businesses from brokers exiting the industry around that time. But we were flat out. And same thing since the Cerveza sickness lockdowns. We've had first home buyers. Obviously, we've had the first home loan deposit scheme guarantee. We've had home builder, as well as people being able to take funds out of their retirement savings. So it was $10,000 per person in the last financial year, and then another $10,000 in this financial year. So if you're a couple, effectively you take $10,000 out in June, another $10,000 out in July. That's $20,000 per person. If you're a couple, that's $40,000 plus all the home buyers grant, potentially up to $45,000 worth of grants there. So you could have literally no savings, and now all of a sudden you've got $80,000, $85,000 deposit for a home. And when we break first home buyers down by state, once again you can see that first home buyers are now rolling over. In fact, first home buyer loan commitments actually fell in the month of April and May. So we can see that, yeah, keep an eye on this. We'll see how this goes. A lot of people are saying that we've now created a first home buyer housing bubble. So there's been talk about a housing bubble for a while, and now we've created a first home buyer housing bubble. When we have a look at the type of loans that have been issued over the last 12 months, there's been a big rise in the number of loans that are above 80% LVR. So a lot of first home buyers, a lot of people with low deposits have been jumping in. That is now kind of peaked by the look of it. Once again, we'll keep an eye on this. And when we look at debt to income, there has been a significant increase in borrowers that have been borrowing more than 6 times their household income, even though banks have apparently put or tightened around this area. I've been in this industry for 17, 18 years. I wasn't aware that some banks were lending 9 times debt to income. I definitely haven't had clients that have leveraged up that much, and I certainly haven't had banks approve loans that have been levered up that much. But apparently, it is. So we have a look at this. Go back to 2019, after the federal election, and interesting. That's when the property market actually kind of started going up after falling for a couple of years. And I'll show that in part 2 of this video, what the property market did leading up to that election. But you can see that the average loan size for owner occupiers, all housing in green, was around $415,000, and now in say 2 years, but really it's shot up quite a lot just in the last 12 months, or even in the last 6 months, as you can see here. So now the average new loan size in Australia is $504,000. We are starting to see tightening. Commonwealth Bank moves first on home loan tightening. So this is, we're seeing banks increase fixed rates. So the 4 and 5 year fixed rate, you can no longer get a sub 2. In Australia, unlike the US that have 30-year fixed rate mortgages in Australia. The most you can get is a 10-year fixed rate. I believe only 2 banks in Australia even offer that. I think a couple of banks offer a 7-year, but the maximum that you can get across the banks is a 5-year fixed term. And that 10-year with ANZ offer a 10-year fixed rate. I think it's something like about 7.5% over 10 years, where you can get a 30-year fixed rate mortgage in the US in the 3s. But we are seeing Commonwealth Bank increase their servicing. So what their rate at what you service it at, they have increased that. Let's see how that goes. By the way, the 3-year bond is actually now nearly 0.5%. So where it was 0.05 only a couple of weeks ago, it's really shot up. It's really shot up. And here's the thing. Even if the RBA don't lift interest rates, if yields in the US rise, and if the Fed raises rates in the US, bank interest rates here are going to rise, because most of our banks borrow in the offshore markets. And so interest rates will rise no matter what the Reserve Bank of Australia does here in Australia. So, yeah, keep an eye on that. And when we look at the bank's non-performing assets, now this doesn't include the last 12, 18 months. In fact, when we had mortgage deferrals, they weren't part of the being recorded as delinquent. But we have seen housing rise. It's still low as non-performing assets on the bank's balance sheets, but it is rising. It is rising. And if interest rates rise, that's going to put a lot more strain on household budgets and the performance of the bank's assets, their mortgage book. And over that time, over the last 2 decades, and look, according to some reports, the growth of the mortgage broking industry in the last 20 years has had an impact on the bank's net interest margin by creating competition, more banks coming in, that banks have been competing on pricing, and so therefore reducing their margins to win business. And but that also puts pressure on banks on their profitability as well. And so it's sitting around that 2% mark is their net interest margin. The other thing that a lot of people aren't aware of is in Australia, the number of mortgages. So a bank's balance sheet is in Australia, the banks in Australia are so leveraged to the property market, with nearly 65% of the bank's balance sheet being residential mortgages. So when you compare that to other countries around the world, our banks are very exposed to the Australian property market. So it is absolutely in their interest to make sure that the Aussie property market doesn't have problems like the US and Ireland and other countries did during the 2008 global financial crisis. But because we've levered up on so much household debt to buy homes, to buy non-productive assets, we've had a complete fall in private business investment since that time. So since the boom of the property market really boomed in the early 2000s, that's when it really began. People have shifted from investing in businesses, and which is productive, creates jobs, creates wealth, real wealth that is. Instead, we've shifted to investing into more speculative and non-productive assets built on debt. I shared this chart in our last video, the Australia's economic collapse video, that even though interest rates during that time have collapsed, because they say, the RBA will say that, by lowering interest rates, it creates business investment, which creates jobs. Well, no, it doesn't. No, it doesn't. Austrian economics isn't empiricism. But if you want to use empirical data, the empirical data says that, the RBA are wrong. And with that, once again, it's the exact time period. So at the beginning of the 2000s, when everyone started jumping into property, we've seen productivity growth in Australia collapse. Absolutely go backwards since then. So, there are now reports saying that that the Australian economy, we've put so much on the property bandwagon that it's now having a negative impact on the economy, and even worse so moving forward in the future. Builders are going bust. Construction material shortages cause costly delays. Now, I talked about this in the last video, and I shared some stories about even a builder here in my office, and some of the largest builders that I've talked to, talking about the price of steel going up 17.5% on the 1st of July. The concreters aren't able to get boxing for the house slabs, and so some concreters are leasing their boxing to others. Apparently, the boxing comes from New Zealand, and that's been a struggle to get boxing. And then there's the waffle pods and other things which have been hard to get hold of and have gone up in price. I shared stories that that some major builders stopped taking contracts in February this year because they were worried about doing fixed price contracts and the cost of materials just continuing to skyrocket, and then those builders having to complete those homes at a loss. And in fact, I know of a story of one builder who had, and I shared this in my last video, 400 odd contracts, and unfortunately he was going to have to do those at a loss, so he just closed his doors. Now he's working as an employee for another builder. So I shared that if this happens, and many builders, I'm also told that suppliers have now decided that they're only going to supply the big builders, that they're not going to supply materials to smaller builders. They've got to ration and decide who they're going to provide materials to. So if this happens, as I said in the last video, the construction sector employs 9% of Australia's workforce. If this does happen, and I'm expecting it to, keep an eye on this. Keep an eye on this. I'm expecting some very difficult time in the construction sector. I've got a lot of clients who are in this sector. This is the sector that I come from. This is my background, so I know it quite well. I've got a lot of contacts in this sector. All my family still operate in this sector, and 2/3 of SMEs, small to medium enterprises, use property as security. And that's the thing, is banks always ask, any kind of business loans or lending for businesses. They want to know, can we take security over some property? Can we have that property? So if they default on their business loans, we'll come and take their house. So this is a bit of a concern, especially if, as I expect, many SMEs to struggle over the next little period, the next 12 months, 2 years. And as I said, Australia's housing market in a triple crisis, new report finds. Is the house price time bomb about to erupt? Australia's housing system is not working for the economy and an immediate overhaul is needed, a new report has alleged. The report calls into question the government's current policy, which dictates that higher prices are good for the economy. So I'll put a link in the description below to this report. So it was done by a whole bunch of economists that have done this report, basically saying that the wealth effect, this lazy economic model of, hey, let's just pump up asset prices using debt. People will feel richer, so they'll go and use even more debt, borrow against that increased asset to go and consume in the economy. It's lazy economics. It doesn't build long-term wealth, and it's not sustainable in the long run. And it actually reduces. I said this in the last video. It actually reduces the economic growth, because we're loading up, especially now, young people with big mortgages to buy prices at very high levels. And you'll see in the next video how much of their income is actually going to towards mortgage repayments. But because a big chunk of their net disposable income is going to mortgage repayments, they don't have any leftover savings to invest in a business or to spend at the store and consume. So we've really tried to squeeze blood out of a stone, and it's coming to an end. It's really coming to an end. And remember, we're at record low interest rates. Any type of rise in interest rates, and I warned in my last video that I'm expecting significant inflation in Australia. We've seen it in other countries, including the US at the moment. I talked about the import costs in China, the increase in inflation there, and how that's going to impact Australia. And therefore, watch yields, watch interest rates. Even if the RBA don't do nothing, watch interest rates. This is going to have a big impact, because as interest rates rise, that's more disposable income that needs to be used towards mortgage payments. And Daniel Lacau, Austrian economist, shared this Bloomberg report, World's Most Bubbly Housing Markets Flash 2008 Style Warnings. And here's the thing, we escaped it in 2008. In 2008, Australia, we had no government debt. In fact, we had about $20 billion in the bank. The government came in and did different stimulus, as I showed in the graph before. They doubled the first home buyers grant, and then China went on a massive infrastructure and commodity spend, which really helped Australia out a lot. However, now we've got government debt, $1 trillion, right? Household debt, even higher, at record low rates. And you'll see in the next video exactly how much disposable income's going to that. Corporations, the debt in the corporate sector. We are now in the boat with the rest of the world. There's, if we have another GFC type 2 happen, Australia, I'm sorry, but we are no longer the lucky country. We're going to experience what other countries experienced in 2008. And when we look at buying conditions for US housing, this is obviously in the US, University of Michigan survey. It is the lowest since the early 80s. Buying conditions for US housing is now the lowest since the early 80s. And when we look at the plan to purchase a home, this is lowest it's been since 2012. So, yeah. Time to buy a house index and house price expectations. So we've got time to buy a house is now falling significantly, and we've got that house price expectations now tipping over. So let's see where this goes as well. You'll see the affordability in the next video, and we have seen in the last 2 months first home buyer loans reduce. So let's just see. Consumer sentiment, conditions for buying a home at all-time lows. And the Fannie Mae National Housing Survey, a good time to buy is now the lowest on record, and a good time to sell, well, not quite the highest on record, but it has ticked up significantly since last year. And I've been sharing over the last 6 months or so, longer, actually probably close to the last 12 months, that I've been using this property boom to sell a bunch of my investment properties. And yeah, I mean, I bought them back in 2012 when they bottomed after the GFC. That was more good luck than, than talent in timing the market. That was just absolutely good luck. And so I've made tremendous gains on those properties in the last decade. Also, timed the currency extremely well. Back then, the Aussie dollar was $1.04, so it was above parity with the US. So great time to buy. Where now the Aussie is 75 and falling. It's fallen from 78 to 75 in the last, since Jerome Powell did his press conference last week. And consumer sentiment. So you'll see in the middle there, time to buy a dwelling in June, it fell below 100. And what's interesting with this one is when consumer sentiment to buy a dwelling falls below 100, usually house prices fall as well. So we just need to keep an eye on this one. And that's where we'll leave part 1. Stay tuned tomorrow for part 2, property market warning.